Welcome back to Higher National Diploma in Accountancy, Financial Statement Analysis, Chapter number 4, Analysis of Inventories. In this video, we are going to cover the cost of inventory, what are the inventory measurements, how we are going to report the inventory on financial statements, inventory valuation methods, how we are going to treat the inventory and cost of goods sold, and what are the effects of FIFO and LIFO on the income, cash flow and working capital, and advantages and disadvantages of FIFO and LIFO methods, and what are the impact on the financial ratios, and LIFO reserve and LIFO liquidation, and adjustment from LIFO to FIFO, and decline in LIFO reserve. Finally, we are going to see how we are going to make the choice in between the LIFO and FIFO. Now let's look at what is inventory. Inventory is defined as assets that are intended for sale, are in the process of being produced for sale, or are to be used in producing goods. The following expression shows how a company's inventory is determined. So here what we are going to do, we are going to take the beginning inventory or the opening stock. Then we are going to add the net purchases. Net purchases are purchases minus the return outward. Then we are going to deduct the cost of goods sold. Then we can arrive at the ending inventory or the closing inventory value. Importance of inventory. Inventories are a major factor in the analysis of merchandising and manufacturing companies. In such companies, generate their sale and profit through inventory transactions on a regular basis. An important consideration in determining profit for these companies by measuring the cost of sales when inventories are sold. Now let's see the cost of inventory. Cost of inventory include cost of purchases, cost of conversion, as well as other costs incurred in bringing the inventories to their present location and condition. These costs are included in the cost of inventory and capitalized and reflected in the statement of financial position. Whereas storage cost of finished inventory as well as abnormal cost due to wastage is treated as an expense in the period which they are occurred in the income statement. Until case 2, inventories are measured at the lower of cost and net realizable value. Net realizable value is the estimated selling price in the ordinary course of business less the estimated cost necessary to make the sale. Let's see how we are going to report inventory on financial statements. Inventory is an asset and its ending balance is reported in the current asset section of company's statement of financial position. However, the changes in inventory is a component in the calculation of the cost of goods sold, which is often presented on company's income statement. An increase in inventory will be subtracted from a company's purchase of goods, while a decrease in inventory will be added to the company's purchase of goods to arrive at the cost of goods sold. As an analyst, you have to focus the following things. You have to remember that inventory method adopted has an impact on the financial statement and any financial ratios that are based on them. As a result, when evaluating a company's performance over the time or in comparison to industry data or industry competitors, the analyst must carefully consider the inventory valuation methods and the differences between them. A company must apply the same cost formula to all inventories of the same type and use to the entity. Changes in the carrying amount of inventory classifications, such as raw materials, work in progress, and finished goods, can provide an insight into company's future sales and profit. Therefore, the inventory turnover ratio, number of days of inventory ratio, gross profit margin ratio are all useful in evaluating company's inventory management. There are three methods of inventory valuation. First one is first in first out, that is FIFO. Second one is last in first out, LIFO. And finally, weighted average cost, which is known as AVCO. Let's see the basic relationship of the inventory and cost of goods sold when there is a change in the price levels. So let's see what will be happen when there is inflation. Inflation is the gradual increase of price. So if the costs are increasing, the items acquired first ever is very cheap in the FIFO method. This decrease the cost of goods sold and it increase the profit. Since the profit are increasing, the income tax also increases. Since the remaining balance will be the current price, the value of the inventory is higher in the statement of financial position. In LIFO, the costs are increasing. Then the recently acquired items are more expensive. This increases the cost of goods sold under LIFO method and it will decrease the net profit. Due to the decrease in net profit, the income tax decreases. Since we are left with the earlier inventories, the value of unsold inventory is lower. Therefore, inventory reflected in the statement of financial position is lower. Now let's see what will happen when the deflationary situation. Deflation is the gradual decrease of price levels. Converse to the inflation scenario, the cost of goods sold is increases in the FIFO. At the same time, the accounting profit is lower. As a result, the income tax also decreases. Under deflationary scenario, the FIFO value of unsold inventory is lesser. Therefore, as the inventory in the statement of financial position, we are going to show a lower amount. In the LIFO scenario, with the deflation, cost of goods sold is decreases. As a result, the profit is increasing. At the same time, the income tax also increases. However, the closing inventory reflected in the statement of financial position is much higher due to the deflationary scenario in the method of LIFO. Let's analyze some more differences between LIFO and FIFO with regard into the income, cash flow and working capital. Since the LIFO allocate the most recent purchase price to the cost of goods sold, the use of LIFO result in higher cost of goods sold and lower reported income. In contrast, FIFO allocate the earliest purchase price to the cost of goods sold, resulting lower cost of goods sold and higher income. The choice of LIFO and FIFO has no effect on pre-tax cash flows. The pre-tax cash flow is determined by the cash inflow from sales and cash outflow from the purchases, neither of which affected by the method of inventory accounting. However, the choice of FIFO and LIFO affect the tax payment. The Sri Lankan accounting standards require the same inventory method for financial reporting as well as tax reporting. Since LIFO generates lower pre-tax income when prices are rising, it will result in lower tax payment and therefore higher after-tax cash flow than the FIFO. Working capital is defined as current asset less current liabilities. Since the LIFO reports lower inventory than FIFO, working capital will be lower under the LIFO method. Now, let's see what are the advantages and disadvantages of FIFO method. When it comes to advantages, it is easy to apply. It's assumed the flow of cost corresponded with the normal physical flow of goods. In other words, normally what we are going to do is we are going to take the stocks or materials which come first into our stores. So that normal behavior is applicable in the FIFO method. No manipulation of income is possible. In the statement of financial position, the amount of inventory is more likely to reflect the current market value. Under the FIFO method, the purchases at the end of the period have no effect on the cost of goods sold or the net income. Now let's see what are the disadvantages of FIFO method. It recognizes the paper profit. Paper profit are unrealized profit. In the time of inflation, FIFO will show increased profit, though this may only be on paper. Second one is, it gives a heavier tax burden for the organization. Normally, in the inflation scenario, since our profit is increased, if you are using FIFO method, the tax burden will be higher. But this may be difficult for a company to manage the expenses at the same time to manage the taxes. Now, let's see what are the advantages and disadvantages of FIFO method. Let's see what are the advantages of LIFO method. LIFO matches the most recent cost against the current revenues. It gives the tax benefit and there's improvement in the cash flows. LIFO also minimizes the written down cost to market. In some situations, physical flow of inventory corresponds to the LIFO cost of flow. As example, just take a coal pile. The most recent coal is added to the coal pile is always on the top of the coal pile. Therefore, the last coal in is always the first coal out. Now let's see what are the disadvantages of LIFO method. LIFO reduces the earning when there is inflation. It underestimates the inventory because it reflects the lesser prices under the inventory. There is a problem of LIFO liquidation. Let's see the impact of LIFO and FIFO on the financial ratios. Let's first see the profitability ratio. Under this, we are going to look at the gross profit margin. So, in the gross profit margin, sales are not affected by the choice of LIFO or FIFO. However, if we are using the FIFO, it will result in lower cost of goods sold and therefore higher net income, and the profit margin will be higher under FIFO. The gross profit provided by the LIFO is lower as the cost of goods sold is higher, and the lower profit margin reported under LIFO. The next one is the return on asset. FIFO result in higher net income and higher average total asset. Since the increase in income is more than proportionate of the average total asset increase, the return on asset is higher in the FIFO method. In the LIFO, it gives the lower income as well as lower average total asset. Thus, the decrease in income is greater than the average total asset decrease. The return on asset is lower under FIFO method. Now, let's look at the liquidity ratios. Under liquidity ratios, since there is no impact on quick ratio, we are going to foresee the current ratio. So, in the current ratio, current liabilities are not affected by the choice of FIFO or LIFO. However, since LIFO is result in lower inventory, therefore, it will give a lower current asset. Thus, the current ratio will be lower under LIFO method. Since the inventory provided by the FIFO is more useful, the higher current ratio reported under FIFO is better for analytical purpose. Under efficiency ratios, let's look at the inventory turnover first. In the inventory turnover, if we are using the LIFO method, the cost of goods sold is higher. However, the average inventory is much lower in LIFO. Therefore, the inventory turnover is higher in LIFO method. When it comes to FIFO method, the cost of goods sold is lower under FIFO and the average inventory is higher. Therefore, the inventory turnover is less in FIFO method. For analytical purpose, LIFO provides the most useful cost of goods sold, while FIFO provides the most useful inventory measure. When it comes to solvency, we are going to talk about the debt to equity ratio. So here, the choice of LIFO or FIFO has no impact on the debt. However, the FIFO results in higher inventory values as it reports higher equity. Therefore, the debt to equity ratio will be lower under FIFO method. However, LIFO results in lower inventory values and equity. Thus, the debt to equity ratio will be higher under LIFO method. Therefore, the lower debt to equity ratio reported under FIFO should be used in the analysis purpose. Let's learn what is LIFO reserve and LIFO liquidation. Now, let's think, why do we need LIFO reserve and LIFO liquidation? Difference between LIFO and FIFO make a comparison between firms difficult. Therefore, to make a comparison between FIFO and LIFO, there must be several adjustments to be made to the financial statements of LIFO firms. LIFO reserve is the amount by which LIFO inventory less than the FIFO inventory. Firms that report under LIFO also have to report a LIFO reserve. LIFO reserve is an account used to bridge the gap between FIFO and LIFO cost. When a company uses the FIFO method to track its inventory, but it reports under the LIFO method in preparation of its financial statements, they have to prepare this LIFO reserve. In period of rising prices, constant increase in cost can create a credit balance in the LIFO reserve, which will result in reduced inventory cost when reported on the statement of financial position. Now let's see how to make financial statements prepared under LIFO comparable to those under FIFO. First, we have to add the LIFO reserve to the LIFO inventory on the statement of financial position. Then we have to deduct the excess cash straight from the lower taxes under LIFO. Then we have to increase the retained earning component of the shareholders' equity. Finally, in the income statement, we have to make adjustment to the cost of goods sold of LIFO and FIFO company comparable. For that, we can use the following formula. LIFO liquidation occurs when a company using LIFO want to get rid of old, perhaps obsolete inventory quickly. They may discount and selling older merchandise in stock or materials in the company's inventory. As a result, the number of units in ending inventory may decline from the number of units that were presented at the beginning of the year. This will produce an inventory-related increase in gross profit, which generally leads to higher taxable income. Sometimes management can use LIFO liquidation to inflate the earnings artificially. LIFO liquidation occurs for a variety of reasons, including the company's sudden cash flow problem, unexpected increase in demand for the company's product, a lack of recent inventory, the need to relocate or dispose of inventory. Most of the time, when there is a shortage of space for new or more goods that correspond to customer wants and needs, they need to relocate it. Then, sometimes it may be due to the events out of management control, such as strikes and material shortages. Let's see what are the factors result in declining in the LIFO reserve. The first one is LIFO liquidation. As I mentioned you earlier, this occurs when a company using LIFO sells more goods or issue more older stocks than it buys. Therefore, the old inventory cost remaining on the inventory valuation method. Therefore, the LIFO reserve will be declined. The second one is the declining prices. You know that when the deflationary environment, it is possible for LIFO reserve to have a negative balance. which caused by the LIFO inventory valuation being higher than its FIFO valuation. Whether a company go for LIFO or FIFO, there's a choice to be made. Therefore, they have to see the estimated tax saving from either of these methods, the inventory materiality, tax losses carry forward, inventory variability, inventory obsolescence, size as a proxy for bookkeeping cost, leverage, current ratio. Hope you have gained some knowledge with regard to the inventory valuation methods and the way in which its impact on the financial statement analysis. So you have to focus that depending on the inventory valuation method, such as FIFO, LIFO, or weighted average, what is the impact on the ratios? At the same time, depend on the pricing situation, such as inflation or deflation, what is the impact on the financial statements? So stay tuned, and in the next one, I will focus on the ratio analysis.